Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Wednesday, March 25th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. We were up 1.15% today on the S&P 500 and closed at 2,475.56. So what we're looking at here is a 5-day, 5-minute chart. So each candlestick represents 5 minutes of trading in the S&P 500. And if you remember from yesterday's video where we talked about the fact that we had a big up day yesterday and as part of what could be a bear market rally, and we finished at the peak of the trading yesterday right underneath this 2450 level, which is why this blue line is there. And as I pointed out, that if this rally, and I want to be very clear on this, guys, I think there was some misunderstandings on my message yesterday. Just because we might have a bear market rally does not mean the bear market is over and we're going into a new bull. Okay, so and we're going to go. This is going to be a very special issue today. So please stick through the entire video. Maybe watch it a couple times, watch it with your friends, whatever. Because we're going to go back and we're going to take a look at bear market rallies here in a few minutes. We're going to go back and take a look at bear market rallies during the last two bear markets, the one from 2000 through 03 and then also 07 through 09. So stick with me. We'll get to that data here in just a few minutes. But first, we need to kind of review what's going on today. All right, so you can see here for the day we gapped up and got over that 2450 level, and then backslid and then bottomed and then had a rally up until just a little bit before 2 o'clock, and then we started to trail off at the end of the day, and again finished up 1.15%. Now, when we pull back and take a look at a slightly longer chart, this is a daily chart that goes back 3 months. I just wanted to focus on this last 3 months so we can kind of take a look at a few things, but I think this is going to be super important for you guys to understand. Again, I've got the 2350 and the 2450 levels annotated here with this blue line. These are really key numbers and support and resistance levels for us to keep our eyes on now and going forward. Now, obviously, here's today's trading, okay, and we cleared and closed above the 2450, and that's all well and fine. But what I want you to also understand is, look at this. That's 2 days that we're positive, okay? We've had 2 positive days. But go back here, guys. Let's backtrack all the way to February 19th when the market peaked. I want to put this in perspective. This is the first time since February 19th, actually before February 19th, that we've had 2 positive days in a row in the S&P 500. So, and this is on the back of $2 trillion of stimulus in that, the government is throwing at the problem here, the markets. So let's not get too excited and think that, the worst is behind us and it's just all uphill from here. Look, when you're doing technical analysis, right, you have to look at probabilities, and I approach it with a if this then that scenario and mentality. So like I said yesterday, if we can get above this 2450 and close above it today and also for a couple more days in a row, then that might tell me that we put in at least a short-term bottom here, okay? There's no absolutes with this stuff, guys. It's too hard. But again, I hope it helps to understand that this is the first time in well over a month that we've had even 2 days in a row where the market went up, and it took $2 trillion of stimulus from the U.S. government to make that happen. So these are still extremely dangerous markets, and let's not get too excited and too anxious to get, put all of our money back to work yet, because it would be very unlikely, possible of course, anything's possible, but it would be very unlikely that this bear market is already over, that the worst has already been seen, that the bottom is put in. Now, again, we could rally, but it doesn't mean I mean, a rally can be a few days or a few weeks, right? We can be in a rally here, no doubt about it. We can be in a bear market rally, but we are in a bear market. And the shortest one on record that I'm aware of was about 6 months. That's the shortest bear market, guys, in history. So the likelihood of us putting in a V bottom here, like we did in 2018 right here, and we're off to the races again, and everything is all well and fine with all these challenges we have in the markets, the coronavirus, the oil markets, the bond markets, and that's just, touching the tip of the iceberg. And the likelihood that this is as bad as it's going to get, I think, is pretty slim. Anything's possible, but it would be highly unlikely for that to be the case. Okay, so now we're looking at the 7-year weekly chart that we've been using for quite a while. Again, each candlestick represents 1 week of trading in the S&P 500, and we can see here why this 2350 level is so important. It's because this is where we bottomed in Q4 of 18. We had some trading during the latter part of Q1 and beginning of Q2 in 2017. So, at this level, at this 2350 level, we've basically lost, pretty much all the progress we made from 2017, 2018, 2019, and first couple months of 2020, and we're trading back here in this, 2017 range. So, that's why this is so important. But this is not a super thick area of support. Again, it kind of aligned with the government coming out and throwing massive stimulus at the markets, and we had the fastest correction in history. We had the fastest bear market in history. We were due for a bounce anyway. So we have these things kind of colliding together, but please don't construe that for your own benefit. Please don't construe that as, hey, the worst is behind us, and and we're okay to double down and take massive risk. I don't think that would be wise at this point. Maybe for some people, this could be, some shorter term traders, this could be a short term tradable rally. But again, I would be extremely careful here, guys, because these are still extremely dangerous markets. And as I stated last night, I want to see this market rally on its own merits, not on the back of stimulus. I want to see, 3 positive days in a row minimum above that 2450 level to kind of at least confirm that we've got at least a short-term rally going on. And, we've got 1 day so far, but, if we can stitch together 2 more days in a row, well, okay, maybe we've got a little rally going on here, but we're still in a bear market. So again, that's why we need to go back and take a look at, these bear market rallies, and we will do that here in just a few minutes. Now, the next thing I want to do, and this will be good for those of you that are on this video that are subscribers to Simple Market Signals, I want to go back and kind of re-educate you, but also if you're not a subscriber to Simple Market Signals, this at least helps you understand what my model does. But even if you are a subscriber, this is going to be a good review. And by the way, this chart is part of this video, the S&P 500 2007 through 09 using Simple Market Signals. It's out on my YouTube channel. So if you haven't seen that, please go ahead and check this out. I also have done the same back testing on the 2000 through 03 time period, and then I was able to dissect what happened in 2018. And for those of you that don't know the story, I worked on the Simple Market Signals model for over 20 years as a trader and an investor and also a financial services professional for several decades. So I worked on this model for over 20 years, and it finally came together. The last piece that I needed finally came together in 2017. So this is back testing, all right? But it's very accurate because once I had the model, then I was just able to go back and see how it would have acted during this bear market. So I've distilled my Simple Market Signals model signals down to a green, yellow, red signal. Easy for everybody to understand. Red, of course, is the worst risk-reward ratio for equity investors. Green is the best risk-reward ratio for investors. So basically what my model does, and remember, I invented it for myself. I now make the data available to you guys as individual subscribers for less than $20 a month. The model and the signals helps us to understand what level of risk is in the market and what level of risk we are assuming. And what I have found is there is a very high correlation between the level of risk in the stock market and the direction that the stock market goes. Okay, and I'm not talking about short-term wiggles. Okay, I'm talking about the bigger picture, the longer trend. So Simple Market Signals is probably not going to help out the ultra short-term traders, the people that are in and out in a few days or even a few weeks, it's probably not going to help you, okay? But at least I hope you guys will find this interesting. It's more for, momentum traders, 6, 8, 10, 12 week plus time frame, long-term investors. That's who simple market signals will help. Now, let's just take a quick review, though, so we all understand whether you're already a subscriber or not, just so you can understand how this thing works, because I want to set some realistic expectations, and then we're going to move on to looking at the bear market rallies from the last two major bear markets over the last couple of decades. So the simple market signals, weekly signal would have went red right here, okay? So I've just kind of put these lines as intersections so we can kind of tell. And again, that would have been right around the 1500 level on the S&P 500, and that would have been back in November of 07. And then you can see here that the signal stayed red up until right here. Now we had this rally, okay? And it finally, right here, the model did in this week, each one of these is a week, right? These candlesticks is a week. Right here, the signal did go green. And then the very next week, as we can see, the rally attempt failed and the signal went red again. So this is called a whipsaw, okay? Guys, that stuff's just going to happen. This is the price. And the way I use this, and people would have to figure out how, you can use the signals however you want, tactically rebalance or, be in and out or however you want to use them. The way I use them is I have very little, if any, equity exposure when the signal is yellow and red, because I know I'm probably not going to make any money when the signals are yellow and red. You have your best opportunity to make money when the signal is green. But when you're in a bear market, you can get these whipsaws where you get rallies where it does trigger a green signal, and then the very next week, the signal, it fails. So, it's just the price you have to pay for cutting your losses, right, for having a system like this. So, this works. This works better than anything else I've ever seen or figured out. But there can be those rally attempts that trigger a signal that fail. I just want to set very realistic expectations. But during this entire bear market, that's the only time in the 07 through 09 time frame that happened. And then you can see the signal remain red through this entire period. And you can see there was some rally attempts here, right? Some of these bear market rallies, like I think we're experiencing right now. And then when the market finally bottomed and came up, you'll notice that the signal went green during this week at about the 875 level, and that was back in April of 2009, towards the end of April and just before the beginning of May of 09. So it helps you understand how much risk you're taking with being in the market. And when the signal goes green, all of the model indicators, and this goes way beyond technical analysis, guys, all of the model indicators are in agreement that risk at this point is low based on the indicators in my model. And as we can see, then once that triggered, then we started to climb out. So hopefully this helps both current subscribers understand. The model is not going to pick the exact bottom, guys. I want to set realistic expectations. But come on, if you could miss the bulk of this downturn, and then, if you could have got out somewhere around here on the red signal, and again, we send you the signals. How you employ them is entirely up to you, okay? You can rebalance, you can not rebalance, you can just go to a lower equity exposure, you can go to zero equity exposure. That, you have to figure that out on your own. We send you the data, you figure out how to employ it. But the point is that only this one green signal, that's the only time we had a signal that failed during this entire bear market, and then we had the green signal there, okay? So hopefully that helps both current subscribers to simple market signals, or if you were on the fence about simple market signals or didn't understand how it worked, this is how this thing works. It helps you understand the risk in the stock market. And again, I have found a very high correlation between the amount of risk that's in the market and the direction the market goes. And based on my experience of working with this model now for about 3 years and then backtesting it for a couple of decades, really all of the upside progress in the stock market is made in the green periods. So hopefully that helps you. Now let's go back and take a look at the bear market rallies from this bear market, as well as the one that happened between 2000 and 03. I thought it might be helpful if we went back and reviewed the last two bear markets we've had from 2000 through 03 and then '07 through '09, and take a look at some of the rallies that happened during these bear markets, because we've been rallying for a couple of days here, and I think a lot of people are suffering from the fear of missing out. They think they missed the bottom or whatever. And guys, I want you to understand that the likelihood of that is very small. However, let's take a look at a few years. So now we're back to 2000. All right, so this is the year 2000. This is the S&P 500, and you can see here. I mean, look at how we rallied. I mean, these are just daily candles here, guys. But look at how you get these big days, right? And you get this rally, and then it fails, and then you get another rally, right? And then it fails, and then you get another rally attempt, and it fails. Okay, so now we're at 2001 again. This is 2001 in the S&P 500. This is a one-year chart. Each candlestick is 1 day. But again, you see we get this rally, it fails. We get the rally, and then it fails. We get the rally, and then let's move to 2003, okay? It fails. We get another rally. It fails, fails. We get another rally. It fails. We get another rally. It fails. We get another rally. And then moving on to 2003, it fails, and then we finally bottomed in March of '03. Okay, so guys, just because we've had a couple of good days in the stock market does not mean that this bear market is over. And I would encourage you to not be fearful of missing just a couple of days, especially on the back of trillions of dollars of stimulus. But now let's move on to '07 through '09. Take a look at that same time frame so you can see a few more periods. I hope this is helpful. I want you to understand that bear market rallies are real. They're violent to the upside. They suck a lot of people back in, and then those people get hurt again. So what we're looking at now is 2007 in the S&P 500. And again, it's a one-year chart. Each candlestick is 1 day. And you can see we started to have, back in July, we started to have some violent swings, and then rallied again, made that rally attempt, and that rally failed, and then we rallied again, and then the market really started to roll over here, starting in Q4 of 2007. But most of the damage happened in that last bear market happened in 2008. So let's now move on to a 2008 chart and see what that looks like. Okay, so now we're on the 2008 chart, and you can see we came into the year, backsliding from that Q4 of '07 time period, which we just looked at, and then we got a rally attempt, kind of a gradual rally attempt, and then it failed, and then we had another rally attempt, and then it failed, and then we started to get more violent swings here. And again, each one of these candles is 1 day, so you get these big up days, and then they fail, and then you get a few more up days, and they fail, and you get more up days, and it fails. And then you get another rally attempt, okay? And that's in 2008 here. So now let's move on to 2009 and see what that looks like. All right, so now we're on the 2009 chart, and you can see that when we came into the beginning of the year, again, the rally that we had towards the end of '08 failed. We went into '09, and it finally bottomed here March 9th of '09, and then started the rally, okay? You can see in both cases, both bear markets, the one from 2000 through '03 and then '07 through '09, you can see there was a lot of bear market rallies that failed. So we have to be very, very careful about assuming just because we've had a couple of days of a rally that the bear market is over and we're magically going to go back to a bull market. Okay, we have to be super careful about that. And again, if one is fearful of missing out on just a couple of good days, maybe that individual should just stay invested full time. But just understand, in a bear market, a person could be down a lot. And let me point out let's jump out to my YouTube channel really quick here, because I want to point out a couple of videos that if you haven't already watched them, you need to watch these. So let's jump out there real quick and I'll show you what I'm talking about. Okay, so now we are out on my YouTube channel, and the first video that you should watch is this Why Losses Matter video. It's less than 3 minutes long, but it walks you through why being a master of cutting your losses is far more important to being a successful trader or investor than it is trying to be in every little wiggle to the upside. And so keeping your losses as small as possible, guys, is actually as counterintuitive as that may seem, that's actually one of the major attributes to being a successful trader or investor. It's far more important mathematically than trying to maximize the upside on every single wiggle in the market. And to get your head wrapped around why that is so important, the math behind that, you need to understand this video, okay? So invest 3 minutes in yourself, watch this video. The other one is how much is a trillion, okay? This video goes into how much a trillion it really is, guys. Most people have no clue how big that number is. And you need to watch that video. It's 7 minutes long. And how much is a trillion is going to help you understand when the government throws $2 trillion worth of stimulus out there, you need to understand just how big a trillion is so that you can start to get your head wrapped around what that really means, okay? And if the markets need $2 trillion of stimulus to prop them up, it means the markets are not on a great footing. All right, so a couple of videos that should help you out there. So please go out and check those out. Again, why losses matter and how much is a trillion. And again, these are both out on the Rodney E. Constable Success channel. Just type in Rodney E. Constable in the YouTube search box, and that will bring you right to my channel. And of course, if you have not already subscribed, please do so.